What if the world finally stopped trusting America's debt? Picture this. You open your phone one morning and the top headline reads, Moody's strips United States of its last perfect credit rating. For a moment, it barely registers because it sounds like the kind of dry financial news that scrolls past without meaning anything. But this actually happened. In May of 2026, Moody's downgraded the United States from a flawless AAA rating down to AA1, and in doing so, it closed a chapter that had lasted since 1917. S&P had already made this move back in 2011. Fitch followed in 2023. Moody's was the last holdout, the final agency still willing to call America's debt as safe as it gets, and now that label is gone for good. The reason wasn't a single event. It was the slow, steady math of a government that has spent more than it collects for decades, that now owes more than $38 trillion, and that is paying over $1 trillion a year just in interest on that debt. To put that in perspective, the government is now spending more to service debt from the past than it spends on national defense, more than it spends on Medicaid, more than it spends on veterans benefits combined. Interest is projected to double again within the next 10 years, climbing toward $2 trillion annually by the mid-2030s. And by some projections, it becomes the single largest line item in the entire federal budget within 20 years. That means the government will soon be spending more to pay for its past decisions than to invest in its future. This isn't speculation dressed up as a headline. It's the current trajectory, confirmed by the Congressional Budget Office itself. So the question naturally becomes, what happens if the people and institutions who buy this debt decide they've seen enough? What happens if the world slowly or suddenly stops showing up to lend America the money it needs to keep the lights on? For most of modern history, that question would have sounded almost absurd. Treasury bonds have been considered the safest investment on the planet, the backbone of nearly every pension fund, insurance policy, and central bank reserve on Earth. Japan alone holds over $1.2 trillion in U.S. treasuries. The United Kingdom holds roughly $900 billion. China, once the second largest holder in the world with over $1.3 trillion in treasuries at its peak, has been quietly and steadily shrinking that number for years, now sitting under $700 billion. Japan's position deserves its own closer look here, because it complicates the simple narrative people like to tell about this trend. Japan remains the single largest foreign holder of U.S. treasuries on the planet, and it has actually been adding to that position over parts of the past year rather than only selling. But Japan is also dealing with its own domestic currency pressures, a weak yen that has periodically forced the Bank of Japan to intervene in currency markets. And intervening in currency markets sometimes means selling dollar assets, including treasuries, to raise the yen needed for that intervention. So Japan's treasury holdings can rise and fall not purely because of confidence in America, but because of Japan's own internal monetary pressures, bleeding into a market that the rest of the world watches closely for signals about American creditworthiness. That's an important nuance because it means some of the volatility in foreign treasury demand isn't really a referendum on America at all. It's collateral damage from other countries managing their own currencies, and mistaking one for the other leads to a distorted picture of what's actually happening. That decline hasn't happened because China suddenly stopped trusting America's ability to pay its debts. It has happened because trust in the dollar system itself as a place to permanently park national wealth has started to erode. And that distinction matters more than people realize. And this isn't really a story about whether America can pay its bills, at least not yet. It's a story about whether the rest of the world still wants to keep buying that promise at the price America is used to paying for it. Because here's the thing that most people miss when they hear the debt is fine, the US can always print more money. The problem was never going to be a sudden default. Nobody seriously expects the United States Treasury to simply refuse to pay bondholders. The real risk, the one already showing up in markets right now, is more subtle and honestly more dangerous in a slow-burning way. It's the risk that buyers start demanding a higher price to keep lending, meaning higher interest rates. And those higher rates compound the debt problem even further, creating a loop that gets harder and harder to escape. And that loop isn't theoretical anymore. In the spring of 2026, a string of Treasury auctions for 2-year, 5-year, 7-year, and 20-year bonds came in weak. Demand fell short of expectations, and to compensate, the government had to offer higher yields to convince investors to show up. Analysts started using a phrase you don't hear casually thrown around in financial reporting. They started calling it bond vigilantes, a term coined decades ago to describe investors who punish irresponsible government borrowing by selling bonds and forcing yields higher until politicians are forced to change course. When one auction for 20-year bonds flopped so badly that yields spiked past 5% for the first time since 2023, right around the same week Moody's issued its downgrade, it wasn't a coincidence. It was the market sending a message. Then in May, a 30-year Treasury bond auction sold at a 5% yield for the first time since 2007, a level that used to be almost unthinkable for what is supposed to be the safest, most boring investment in the world. Imagine what that spike actually means once it ripples outward. Every single time the government borrows more, and it borrows constantly just to cover existing obligations, it now has to pay a steeper price to do so. Higher yields on government bonds don't stay contained inside Washington. They set the tone for mortgage rates, for auto loans, for business financing, for credit card interest, for essentially every borrowing cost across the entire economy. A family hoping to buy a home suddenly finds their monthly payment several $100s higher than it would have been 2 years earlier. A small business owner looking to expand finds that the loan they were counting on now costs so much more in interest that the math no longer works. A company planning to hire 10 new employees quietly decides to hire 6 instead. None of this happens as a dramatic single event you'd see announced on the evening news. It happens gradually in the background, showing up as slightly higher costs everywhere you look, until one day you realize the entire economy has quietly become more expensive to operate in. Now layer another piece onto this. While all of this has been happening domestically, something bigger has been shifting globally, and it's the kind of shift that used to only exist in economic textbooks describing empires from centuries past. Central banks around the world have been buying gold at a pace not seen since the era of fixed exchange rates. In 2024 alone, central banks purchased over 1,000 tons of gold globally, more than double the average from the decade before. That buying spree continued through 2025 and has only intensified into 2026, with a record share of central banks, somewhere around 45%, according to the World Gold Council's most recent survey, saying they plan to buy even more gold this year. And here's the detail that should genuinely stop you for a second. For the first time since 1996, gold now makes up a larger share of global central bank reserves than U.S. Treasuries do. Let that sink in for a moment. For nearly 3 decades, holding U.S. government debt was the default, the safe, boring, obvious choice for any country looking to park its national savings. Now, for the first time in a generation, more of that global reserve wealth sits in gold bars than in American IOUs. Why would that shift happen? Central bankers surveyed on the subject have been remarkably candid about their reasoning. Many pointed directly to what happened after Russia invaded Ukraine in 2022, when Western governments froze roughly $300 billion of Russian foreign reserves almost overnight. That single event taught every finance ministry and central bank on the planet an uncomfortable lesson that dollar-denominated assets can be frozen, sanctioned, or weaponized by political decisions made in Washington, decisions a foreign government has no control over whatsoever. Gold, by contrast, cannot be frozen by a foreign government's sanctions list. It cannot be devalued by another country's monetary policy. It sits quietly, physically, outside the reach of anyone else's politics. So nations that worry about their relationship with the United States souring in the future, nations that want to hedge against being caught on the wrong side of the next geopolitical dispute, have been steadily converting some of their dollar holdings into something no foreign government can touch. This is happening at the same time that groups like the BRICS nations, which now include Brazil, Russia, India, China, South Africa, and newer members like the UAE and Saudi Arabia, have been actively building alternative payment systems designed to settle trade without ever touching the US dollar at all. A system sometimes referred to as BRICS. Pay is being built specifically to link countries' domestic payment networks together, allowing oil, technology, and agricultural trade to move directly between local currencies. It's important to be honest here and say this isn't some overnight death of the dollar. There is no single BRICS currency ready to replace it. And even India, a founding member of the bloc, has publicly stated it isn't pursuing full de-dollarization. The Chinese yuan still makes up only about 2% of global reserves, essentially unchanged for years despite enormous effort to promote it, largely because China's strict capital controls make it nearly impossible for the yuan to function as a truly free global reserve currency. The dollar still accounts for somewhere around 57 to 60% of global foreign exchange reserves, still dominates roughly 90% of global trade transactions, and still sits at the center of nearly every major financial system on Earth. But something more interesting than a sudden collapse is happening. Something economists have started calling a shift from dollar exclusivity to dollar-centered competition. It's not a story about the dollar disappearing. It's a story about the dollar slowly sharing its throne, about a more fragmented multipolar system emerging where the dollar remains dominant but is no longer the only credible option sitting at the table. The euro's share of international reserves has crept up to around 20%, boosted by a wave of euro-denominated bond issuance that reached its highest level since the currency's creation. Meanwhile, the dollar itself has been having one of its roughest years in recent memory. The US dollar index, which measures the greenback against a basket of major currencies, fell to a 4-year low in early 2026. dropping close to 11% over the previous year, one of the steepest declines the dollar has experienced since the 1970s. Some of the largest banks on Wall Street have projected the dollar could fall another 10% before this cycle is finished. There's another piece of this puzzle that rarely gets the attention it deserves, and it's the quiet arrangement often called the petrodollar system. For roughly 50 years, the vast majority of the world's oil has been priced and traded in US dollars, a legacy of agreements struck with Saudi Arabia and other major oil producers back in the 1970s. That arrangement created a permanent, built-in global demand for dollars because any country wanting to buy oil first needed to acquire dollars to pay for it, which in turn meant those countries needed somewhere to park their dollar earnings, and Treasury bonds became the obvious, safe parking spot. This single mechanism has quietly underwritten a huge portion of the demand for U.S. debt for half a century. But that arrangement has been fraying at the edges too. China has been settling a growing share of its oil purchases from Russia and parts of the Middle East in yuan rather than dollars. Saudi Arabia, once the most reliable anchor of the petrodollar system, has explored pricing some of its oil exports in other currencies, as its relationship with Washington has grown more complicated. None of this replaces the dollar's role in oil markets overnight, and the vast majority of global energy trade still runs through dollars today. But every barrel of oil that gets settled in a currency other than the dollar is one small brick removed from a foundation that has supported American borrowing power since before most people alive today were born. It's the same story playing out in a different arena, not a dramatic single break, but a slow accumulation of small defections that eventually add up to something structurally different. So now picture the full chain reaction, laid out from beginning to end, the way it would actually unfold in the real world rather than in a single dramatic headline. Weak demand at Treasury auctions pushes yields higher because buyers demand more compensation for the risk of holding U.S. debt. Higher yields increase the government's own borrowing costs, which are already consuming an enormous and growing share of federal revenue. Rising deficits and rising interest costs feed directly into further credit rating concerns, exactly the kind of concerns Moody's cited when it made its historic downgrade. At the same time, a structurally weaker dollar makes imported goods more expensive for ordinary American households, adding pressure to inflation at a moment when the Federal Reserve is already trying to walk a tightrope between cutting rates to support growth and keeping rates high enough to fight inflation. If the Fed cuts rates too aggressively to ease the government's borrowing burden, it risks reigniting the very inflation it spent years trying to bring under control. If it keeps rates high to protect the dollar and fight inflation, it risks strangling economic growth and making the government's interest bill even larger. There's no comfortable exit from this particular corner. Meanwhile, foreign central banks continue diversifying a slice of their reserves into gold and other assets, not abandoning the dollar system entirely, but steadily reducing their exposure to it, which itself puts additional downward pressure on demand for treasuries precisely when the government needs that demand the most. It's worth pausing here to be clear about what this scenario actually is and isn't. This is not a story about America suddenly defaulting on its debt tomorrow. Nobody serious is predicting that, and the mechanics of how the Treasury and Federal Reserve function make an outright default virtually avoidable in the near term. The U.S. government controls its own currency, meaning it can always create more dollars to meet a dollar-denominated obligation, something a country like Greece or Argentina, borrowing in a currency they don't control, simply cannot do. This matters enormously, and it's a genuine structural advantage. But there's a difference between avoiding default and avoiding damage. The mechanism by which this crisis actually plays out isn't a sudden refusal to pay. It's a slow, grinding erosion, higher borrowing costs that squeeze the federal budget more each year, a weaker currency that quietly taxes every household through higher prices on imported goods, and a shrinking pool of foreign buyers willing to finance America's spending habits at the same generous terms they once offered without a second thought. Imagine the practical, everyday version of this playing out over the next several years, rather than overnight. Mortgage rates that stay stubbornly elevated even as the Fed cuts its benchmark rate, because long-term Treasury yields are set by bond market sentiment, not by the Fed alone, and that sentiment has grown warier. Government agencies quietly scaling back programs, not because of a single dramatic budget cut, but because a growing share of every tax dollar collected gets automatically redirected toward paying interest rather than funding services. Politicians on both sides of the aisle promising fiscal responsibility during campaign season and then passing spending bills that add trillions more to the deficit once elected, a pattern that has repeated itself across multiple administrations, regardless of party, and one that ratings agencies have explicitly cited as a reason for losing confidence in Washington's ability to fix this on its own. Meanwhile, a segment of global capital, still a minority but a growing one, continues finding its way into gold, into other reserve currencies, into alternative payment networks that quietly reduce reliance on the dollar for day-to-day international trade. Financial markets themselves have started reflecting this unease in ways that go beyond the bond market alone. Stock markets that once treated Treasury bonds as the automatic safe haven during moments of turmoil have begun behaving strangely, with episodes where stocks, bonds, and the dollar all fell together on the same day, a pattern that used to be rare enough to make headlines on its own. Traditionally, when stocks sold off sharply, investors fled into treasuries for safety, pushing bond prices up and yields down, a reliable pattern that had held for decades. When that relationship breaks down, when investors sell stocks and bonds and the dollar all at once, it signals something more unsettling than ordinary volatility. It signals that investors are questioning the safety of the entire American financial system rather than rotating between its parts. Wealth managers have started describing a shift among their institutional clients, corporations, and pension funds, thinking further ahead than usual, deciding to hedge their dollar exposure using currency forwards and options in ways they rarely bothered with when dollar dominance felt unquestionable. That hedging activity is itself a subtle vote of reduced confidence, a signal that sophisticated investors are no longer treating dollar strength as a guaranteed constant in their long-term planning. None of these individual pieces feels catastrophic in isolation. That's exactly what makes this scenario worth paying attention to, because slow-burning structural problems are historically far more dangerous than sudden shocks, precisely because they're easy to ignore for years, while the underlying foundation keeps eroding. There's a useful historical parallel worth mentioning here, and it's the British pound. At the end of the Second World War, the pound sterling represented around 64% of global reserves, a dominance that felt just as permanent and unquestionable to people living through it as dollar dominance feels to us today. By 1975, 3 decades later, that share had collapsed to under 10%. The transition wasn't caused by a single crisis. It unfolded gradually through a mix of imperial decline, war debt, and a slow loss of confidence that compounded year after year until one day economists looked back and realized the shift had already happened. Nobody living through 1946 believed the pound could lose its throne that quickly, and yet it did, not through collapse, but through erosion. This doesn't mean the dollar is destined to repeat that exact story on the same timeline. America's economy remains the largest, most dynamic, and most innovative in the world. Its capital markets remain deeper and more liquid than anywhere else on Earth by a wide margin, a genuine structural advantage that took decades to build and that no rival currency can replicate quickly. Its military and geopolitical influence still underwrite a huge amount of global trust in its financial system. Even central bankers who are actively diversifying into gold openly admit, in their own survey responses, that dollar-denominated assets still offer a depth and liquidity that alternatives simply cannot match yet. But not yet is doing a lot of work in that sentence, and every single one of the trends converging right now, the credit downgrade, the weak bond auctions, the record gold buying, the falling dollar index, the slow diversification of reserves, the political gridlock in Washington around spending, are all pointing in the same direction rather than offsetting each other. When trends align instead of canceling out, the pace of change tends to surprise people because humans are naturally better at imagining sudden collapse than at imagining slow, compounding decline. So what would America actually do if this pressure keeps building rather than easing off? History and current policy responses both point toward a few likely paths. The Federal Reserve could step in more aggressively, buying government bonds directly to keep yields from spiraling, essentially creating money to soak up the debt that foreign buyers are less enthusiastic about purchasing. This has a name. It's called monetizing the debt. And it comes with a serious trade-off, because injecting that much new money into the financial system risks reigniting the exact kind of inflation that erodes the purchasing power of every paycheck and every savings account in the country. Alternatively, Washington could pursue the far more politically painful route of actually reducing deficits, either by raising taxes, cutting spending, or some combination of both, a path that virtually every credit rating agency has explicitly said would be necessary to reverse this trajectory, and a path that virtually every recent Congress has failed to deliver on regardless of which party held power. A third possibility, and arguably the most likely one in practice, is a messy combination of both, some inflation, some spending restraint, some higher taxes playing out over years rather than through any single dramatic reform, with the government essentially growing its way partially out of the problem while accepting a permanently higher cost of borrowing as the new normal. It's also worth asking honestly what could actually reverse this trajectory, because the story isn't necessarily a one-way street toward decline. A period of sustained, disciplined deficit reduction, the kind that briefly happened in the late 1990s when the federal government actually ran budget surpluses for several consecutive years, would go a long way toward restoring the kind of confidence that credit rating agencies and foreign buyers are looking for. A wave of genuine productivity growth driven by new technology, something serious economists point to as a real possibility given ongoing advances in artificial intelligence and automation, could grow the economy fast enough to shrink the debt as a share of GDP even without dramatic spending cuts, essentially allowing the country to grow its way toward a healthier ratio rather than cutting its way there. A period of global instability elsewhere, a crisis in China's property sector, a European banking scare, a war that draws capital back toward safety, could easily send investors rushing back into treasuries, regardless of the long-term structural concerns, because in a genuine flight to safety, America's deep and liquid markets still have no real substitute, at least not yet. Confidence in financial markets rarely moves in a straight line, and it would be a mistake to treat every current warning sign as destiny rather than as a trend that responsible policy could still bend in a different direction. None of these paths are catastrophic on their own. All of them involve real trade-offs that ordinary households will feel, whether through higher prices, higher taxes, reduced government services, or some blend of the three. This is what makes the what-if question so much more interesting than a simple doomsday scenario. The realistic version of this story isn't a sudden global financial collapse triggered by foreign governments dramatically announcing they're done buying American debt. It's already happening in slow motion, visible in auction results, in credit rating decisions, in gold reserve data, in currency index charts, available for anyone paying attention to see in real time rather than imagine as some distant hypothetical. The transition, if it continues, will likely take years or even decades to fully play out, the same way the pound's decline took decades rather than months. But the direction of travel right now, based on every major data point from 2026 alone, points toward a world where America's ability to borrow cheaply and easily, a privilege it has enjoyed for the better part of a century, is no longer something it can simply take for granted. A world where each Treasury auction becomes a small referendum on global confidence in American fiscal management, where each credit rating review carries more weight than it used to, where the interest paid on yesterday's decisions increasingly crowds out investment in tomorrow's priorities. In a deeply interconnected global financial system, the decisions of foreign central banks, foreign governments, and foreign investors, decisions made quietly in finance ministries in Tokyo, Beijing, Riyadh, and Brussels, are already reshaping the economic path of ordinary Americans who have never given a second thought to a bond auction in their entire lives. The bonds sold last month at a slightly higher yield than expected will show up eventually as a slightly higher mortgage rate, a slightly higher car payment, a slightly more expensive grocery bill. That's the actual mechanism connecting an obscure Treasury auction to the household budget of a family that has never heard the phrase bond vigilante in its life. Think about what this actually means for someone in their 20s or 30s right now, someone just starting a career, saving for a first home, thinking about starting a family. The interest costs projected for the next decade alone, $16 trillion according to the Congressional Budget Office's own numbers, represent money that will not be available for infrastructure, for research, for education, for the kinds of long-term investments that historically made the American economy the envy of the world. That's not a partisan talking point. It's simple arithmetic. Every dollar spent servicing yesterday's borrowing is a dollar that cannot be spent building tomorrow's economy. A generation that grew up believing government borrowing was essentially a free lunch, a way to fund programs today without anyone really paying the bill, is going to discover that the bill was simply deferred, not canceled. And the interest on that deferral compounds every single year, whether anyone notices it or not. Higher borrowing costs for the federal government eventually translate into a more expensive cost of capital for the entire economy, meaning slower business formation, slower wage growth, and a harder path to the kind of prosperity older generations took for granted. This is the quiet, unglamorous version of a financial crisis, not a single crash people will remember watching unfold live, but a gradual tightening of what's possible, felt most acutely by people who are just entering adulthood right as the bill starts coming due. So the real question isn't whether foreign countries will suddenly and dramatically stop lending money to America overnight. That dramatic version makes for a great headline, but it isn't the version actually unfolding in front of us. The real question, the one already being answered in real time through every auction, every credit downgrade, every ounce of gold added to a central bank vault, is how much more the world will demand in return for continuing to trust America's promises, and how long the United States can keep paying that rising price before something has to give,